Hello. Today we're going to chat about the work of the International Sustainability Standards Board and the International Accounting Standards Board and how we work together at the Foundation now that we have two standard setting boards and how our work aims to deliver a better reporting package for investors. And during the discussion, we're going to use some specific examples to bring this to life a bit. I'm Sue Lloyd, Vice Chair of the International Sustainability Standards Board, or ISSB, and I'm really delighted today to be joined by my counterpart and indeed my successor at the IASB, Linda Mezon-Hutter, who is their Vice Chair. So Linda, if it's okay with you, I might hand over right away to you because I think it's really because of you that we are here having this conversation in the first place.
Thanks, Sue. And yes, you are right, I guess. I was the catalyst for this. So as listeners may or may not know, one of the things that Sue and I are responsible for is looking after how the two boards coordinate their work. And pretty soon after I took that role on, I walked in to see Sue and told her that I thought that we had a problem. We were running around talking about connectivity, and as a relative newbie who had just come into the organization, I spotted that while the IFRS Foundation might think that what we meant by that term was clear, I was pretty sure that wasn't the case for our stakeholders. So I suggested that we find ways to improve our communication about how we are working together and how the work of the two boards is connected. So here we are, I guess, just doing that now. So a good place to start is probably to stop using labels and to describe what we are doing and what we are hoping to achieve. And this slide is designed to set that out. So what are the two boards trying to achieve at the highest level when we think about our respective work? Ultimately, we care about the outcomes of how our products work together. We want to ensure that if a company is using the standards that the IASB and the ISSB issue, that the standards work well together. We're focused on the impact we're having on our stakeholders. That we use common concepts when applicable, that if we use the same words, we mean the same thing, and that the standards ask companies to do things that are complementary rather than conflicting. And then, if we look at outcomes of applying the standards, we want to make sure that the information provided to investors in the financial statements and in the ISSB's sustainability-related financials disclosures work well together, and they meet investors' information needs. We want to avoid unnecessary overlaps in information or gaps, and we want to make sure that the information that is provided can be understood well as a package. And to achieve these objectives, we need to make sure that we have processes in place that help us. I think it's pretty clear that people agree that what we are seeking to achieve here is important, so that our stakeholders are rightly asking for reassurance that we are thinking about this seriously. And I'm happy to provide that reassurance. We know that this is really important, and we have processes in place to really support our objectives of getting our standards to work together to support a well-connected reporting package. And Sue, I think you've got a lot to say about a well-connected reporting package.
Some people would say I've got a lot to say about everything. Thanks, Linda. So what we want to do in our conversation today is to use some examples to illustrate how our standards are being designed to work well together and how the reporting outcomes are connected and the processes that we're using to support this that Linda just touched on. But before we get on to the examples, I think it might be helpful first to describe what the two boards focus on, as this really gives us some helpful context. So at the ISSB, we want to make sure that that investors have the information that they need to understand how sustainability-related risks and opportunities affect a company and how a company is responding to those risks and opportunities. The IASB standards, on the other hand, set out how to report a company's financial performance and its financial position in the financial statements, what needs to be recognised, how to measure the items that are included in the financial statements, and the contents to the notes to the financial statements. And I think the first thing I'd like to say is that the IASB's role is unchanged by the establishment of the ISSB. Our roles are very much complementary. So, for example, if a sustainability risk or opportunity gives rise to a need to recognise an item in the financial statements or to adjust the carrying amount of an item in the financial statements, that would still be addressed in the IFRS accounting standards. So that's Linda's job. A simple example would be that if a company decides to invest in new property, plant and equipment that is needed to reduce its greenhouse gas emissions, while information about that plan would be something that we'd be really interested to get information about when a company uses our sustainability disclosure standards, S2 in this case, to explain how a company is responding to climate-related risks and opportunities. When that property, plant and equipment is ultimately recognised in the financial statements, when you do that, how you measure it and how you account for that asset is clearly in the scope of the IASB's work. But I guess when it gets interesting is when sustainability matters affect a company's financial performance and financial position as reported in the financial statements, and when the ISSB asks for information about those effects on the financial statements. But we'll get on to that. So I promised we'd use some real examples, so let's get on to that. And I am sure that nobody listening to this recording would be surprised that I'm going to use our inaugural standards, S1 and S2, first as a basis to illustrate what we're talking about here. So in terms of connected products, I'm going to look at how you can see the heritage of the International Accounting Standards Board in S1 and S2, so in the standards and the words that we wrote. And in terms of outcomes, I'm going to talk about how S1 and S2 have created some connections in what we both asked to have reported. So on the standard setting side, the first thing I'd note is that we have borrowed the IASB's languages and concepts shamelessly, starting right at the core of our standards with the definition of materiality that we use. So when a company determines what it has to report, just as it would when it prepares financial statements using IASB accounting standards, the company needs to determine whether information is so important that if it was misstated, obscured, or omitted, it could reasonably be expected to actually influence investment decisions. That's a well-known test that's been developed over time. It's got practice built up around it, and we're making use of that heritage and practice, applying it in a new context. And we use other IASB reporting concepts, such as the definition of a reporting entity. And in fact, we require in S1 that the reporting entity that provides the sustainability-related financial information is the same reporting entity that provides the financial statements. And what do I mean by that? It means, for example, that if the general purpose financial reporting package includes financial statements that are consolidated financial statements, the sustainability information that would be provided using S1 and S2 would be that provided for the group as well. So we would be asking for information about sustainability-related risks and opportunities that affect the prospects of the parent company and its subsidiaries. S1 also creates a connection in how the information is reported by requiring that the ISSB's sustainability-related financial disclosures are included in the general purpose financial reporting package, in the same package as the financial statements. Now, we don't specify exactly where that sustainability-related financial disclosure has to be provided within the general purpose financial reporting package, but we do ask companies to provide that information together with the related financial statements. Now, in terms of what's reported on, S1 and S2 ask that information be provided about a company's sustainability-related risks and opportunities. But that isn't limited to information that isn't captured in the financial statements. And that's important. So I'm going to say it again. S1 and S2 don't only ask for things not already captured in the financial statements. Now, certainly in some cases, sustainability-related risks and opportunities will only affect the financial statements in the future, or perhaps they'll never have effects on the financial statements. And S1 and S2 certainly emphasizes the importance of considering the short, the medium, and long-term effects. So the information we ask for is very much inclusive of that which is forward-looking. But in some cases, sustainability-related risks and opportunities will affect the amounts reported in the current financial statements. And that's important because I think sometimes people think that the ISSB is only covering things that haven't already been captured in financial statements, or information that's too forward-looking to ever be included in the financial statements. Some even refer to sustainability information as being pre-financial, and that's not quite right. I think quite importantly, S1 asks companies to provide information in a connected manner. And this is one of the key overarching requirements in the ISSB standards. And those connections include explaining connections with information in the financial statements. And S1 and S2, respectively, ask that information be provided about the effects of sustainability-related risks and opportunities in the current financial statements and the anticipated effects on future financial statements be explained. S1 also requires that consistent assumptions be used in the sustainability reporting and in the financial statements. And so where there's an effect on the from sustainability-related risks and opportunities on the financial statements, that information is something that the ISSB asks a company to explain. Furthermore, applying our standards, a company may need to sometimes explain why a sustainability-related risk or opportunity has not affected the financial statements. For example, why a company hasn't recognised a provision where it's making commitments associated with its net zero targets. Taking a step back, asking for information that explains the connections in the picture provided in the financial statements and in the sustainability-related financial information is a really important part of the ISSB standards. And that's because it's a response to a common request we've heard from investors that they want information to enable them to better understand whether and how what a company is saying about its sustainability-related risks and opportunities is reflected in the financial statements. Now, I mentioned that S1 requires companies to use consistent assumptions in the financial statements and in the sustainability-related financial disclosures. And this is an area where we've been really, really careful to think carefully about how our standards work alongside the IASBs and indeed with other accounting standards. So we were really careful to think about how the disclosures we ask for relate to what is set out in the accounting standards and what's reported in the financial statements. So we say that assumptions must be consistent, but we go on to say to the extent that that's possible, given the accounting standards that an entity is applying. So we were really careful not to override in any way the accounting requirements, but we do ask companies to explain any significant differences in the assumptions that they use. We were also really careful to think about how the reporting package would work well together. So S1 enables information to be included by cross-reference. Remember that we don't specify where sustainability-related financial disclosures have to be provided in the general purpose financial reporting package. And by allowing cross-referencing, this means that a company could potentially cross-reference to information that's included in the financial statements to meet that requirement in S1 and S2 to explain the effects of sustainability or climate-related risks and opportunities in the current financial statements. And we did that because we don't want duplication in reporting, and we want to really make sure that the reporting package can facilitate communication to investors. So Linda commented on processes and the importance of having processes in place to sort of achieve these outcomes that we're looking for in terms of our standards working well together and the reporting working well together. And so I think the next thing I want to just touch on briefly is how did we get to the situation with S1 and S2 that has resulted in these connected outcomes? The first thing to say is that we didn't have joint IASB and ISSB board meetings, and I think that's important because it shows that in itself we don't have to work that way in order to get to connected outcomes. The staff had an enormous role to play though. We actually had a member of the IASB staff, thank you Julia if you're listening to this recording, who was seconded to us at the ISSB to lead our drafting work on S1. And in addition to that, on many other topics, we referred to members of the IASB technical staff to test our concepts and wording. And of course, it helps that I used to be on the IASB, and a couple of our other board members, Richard Barker and Bing, were previously members of the IASB technical staff. And several IASB members were kind enough to review some of the near final drafts of S1 and S2 to provide their input so we could have another safety check that we weren't missing something on the connection front. And as a general matter, we were just really careful to stay abreast of any discussions that were ongoing at the IASB to make sure we were utilising ideas and concepts in a consistent way. Anyway, I've talked for far too long, so now I'm going to hand over to you, Linda, to talk about what the IASB has done and is doing that touches on sustainability, perhaps busting another myth that because, of course, the ISSB doesn't own sustainability-related risks and opportunities at the Foundation, and sometimes when they're relevant to financial statements, that's very much the IASB's domain.
Well, Sue, quite so, and I'm happy to talk about this. The publication of S1 and S2 is a good time really to remind people of that. So sustainability has been on the radar of the IASB for quite a while now. In fact, we were thinking about this before the ISSB even existed. So for example, going back to 2019, Nick Anderson, an IASB board member, published an article that was followed by educational material in 2020 that reminded people that even though you don't find the word climate or the word sustainability, if you do a word search in our accounting standards, that doesn't mean that you don't have to think about those things when you apply our standards. We have just updated and republished that education material. Furthermore, in May this year, we published additional educational material to highlight that this is also the case for the IFRS for SMEs standard. So the focus of the IASB standards is on what needs to be recognized in the financial statements, how the items in the financial statements are measured, and also what must be included in the notes to the financial statements. And sometimes sustainability-related risks and opportunities will affect the amounts or disclosures included in the financial statements using the existing requirements in our accounting standards. And the education materials that we have just republished are a reminder of that. So let's take climate risk. The educational material points out that the effects of climate risk is material in the context of a particular company's financial statements taken as a whole, that risks should be considered when preparing financial statements using our accounting standards. Now, even when a company is exposed to climate-related risk, that doesn't mean that there will always be an effect on what is recognized or how things are measured, or even in the note disclosures in the financial statements, but companies need to think about it. And the educational material gives some examples of when this may happen. For example, a company's exposure to climate risk may indicate that an asset is impaired. Wildfires and floods could negatively affect a borrower's ability to meet its debt obligations, and that could trigger recognition of expected credit losses by the lender. Or a decline in the demand for products that emit greenhouse gases could indicate that a manufacturing plant may be impaired, requiring the asset to be tested for impairment. Climate-related matters may also affect recognition of liabilities. For example, regulatory requirements to remediate environmental damage could result in provisions reported in the financial statements. So it can be the case that there is an effect on financial statements caused by a climate risk or other sustainability-related risk or opportunity coming from applying IASB accounting standards. But it's not always necessarily the case. So for example, a company that announces its net zero targets, that won't necessarily lead to an immediate recognition of provisions in its financial statements. And that is because a net zero target that will take actions of the entity in the future into consideration doesn't necessarily mean that the company has an immediate liability. Our accounting standards include important thresholds or conditions that determine matters such as when assets and liabilities get recognized. Right, Sue?
Yeah, and that's a really good example. So in that case, turning back to S1 and S2, as of course I would, the effects of climate risk on the financial statements, as well as the lack of an effect, could be an example of a connection that we would be expecting to be explained to meet the requirements in the ISSB standard. So it's another good example of a connection. And as I said, when there is an effect reflected in the financial statements, that could potentially be resulting in a cross-reference to the information in the financial statements as a way to meet that requirement in S1 and S2 to explain these effects to investors.
Yep, that's a good example of another connection. We also have a live example of an IASB project where connections in our products and reporting outcomes are relevant too, and where we have processes in place to support this. In response to our last agenda consultation, many stakeholders highlighted the importance of an appropriate reflection of climate-related risks in the financial statements. This feedback reflected perceptions that there may be an inconsistent application of our accounting standards to those risks and that information about those risks in financial statements is insufficient. As a result of this feedback, the IASB has decided to undertake a project to research the causes of stakeholder concerns and to consider whether and what narrow scope actions may be needed. This project is at early stages, and there's a number of possible outcomes, including minor amendments to our accounting standards, limited new application guidance, or perhaps new illustrative examples. Now, when we look at this project, one of the things that we are aware of at the IASB is that it's really important that the IASB consider the work that the ISSB has just completed in S1 and S2 when it's relevant. So, for example, if the IASB were to focus on climate, the terminology will need to be either clearly and intentionally the same or intentionally different from the terminology the ISSB has used when referring to climate-related risks and opportunities in S2 so that the respective scopes are clearly set. To ensure that any actions, including potential standard setting undertaken by the ISB, is complementary to and works well alongside S1 and S2, we have put processes in place to ensure that the standards or materials we each produce and the resulting reporting connects well. So the staff team working on the IASB project includes members from the ISSB technical team that worked on S1 and S2, and also includes an ISSB member who provides strategic input to the staff. These examples show how even though we have the ISSB now, because the IASB is responsible for ensuring that information required in the financial statements meets investor needs, if a sustainability-related risk or opportunity is relevant to the financial statements, that is still within the scope of the IASB's work.
Thanks for that, Linda. So I'm hoping that these examples are helpful to those of you listening as a reminder of the content of some of our materials, so S1 and S2 from my side, and the IASB's educational materials about the effects of sustainability-related matters on the financial statements, and to make people aware of the latest IASB project in the space. And hopefully also we've managed to illustrate how the role of the two boards differs, but also where there are definitely points of interaction that we're really carefully considering. Now, I've got no doubt, Linda, that there's going to be plenty more for us to talk about in the future on this topic, but I think we've covered what we need to today.
Yep, I think that's about it for now and for today. So thanks everyone for listening to us, and I hope that you found this discussion both interesting and helpful.